So let's dig into the weighting a little bit more. There are really only three different styles of weighting an index. You can have the price, which really just is a movement. The index moves based on the underlying price of the stock. You have value, which is really going to be based on the market capitalization of the underlying stock times by the outstanding shares, and that creates the value or the market capitalization of the stock, and that's what we talk about in value. And then you have equal weighting. Equal weighting is really just the same dollar of value invested in each one of the shares regardless of the market value or the price. We just take the underlying shares and we place an equal value into each one of the stocks. But what we'll do now is let's dig into an example of each one of these creations so we can understand the nuances and get familiar with this. So let's take the price weighted index, which is the Dow Jones Industrial Average. And what we're going to do is first create the index at a point in time. And the times are really just irrelevant for now. But the first stock is valued at $100 a share, second stock at $20 a share, and the third stock at $30 a share. So the basic index is created by summing these three and getting $150, dividing by the three stocks, A, B, C, and you can see that the value of the overlying index is based at 50. Now let's take a second point in time, and we're keeping B and C shares the same just for example purposes of this example, and we've increased the value of stock A by 50% to $150 a share. So once again we'll just sum these three together and we get 200, divide by the three shares that are in the index, and you can see that we have 66.67 for the new index. So it's moved from 50 to 66.67, which is a 33% increase in the underlying index. So at this point you'd be saying that the index, let's call it the Dow index is up 33% this year. That would be the first methodology. Now we're sticking with price, but just for this argument or this example, we're going to leave the A share at 100 and the C share at 30, but we're going to increase the B share by 50%, which is the same percentage amount that we increased the A share by in our first example, and that moves this to 30. So let's sum again. We get 160, divide by the three shares, and we get a movement in the underlying index to 53.33, which when we reflect back to the initial index value of 50, it's up 3.33 points or 6.67. So what the example is showing us is even though we had a 50% movement in these two shares, the value of the index only increased to 6.67% versus 33%. So as you can clearly see, the index is skewed to the high dollar priced stock versus percentage movements. The only other thing you really need to know in the price weighted index is that whenever there's a split, that there needs to be an adjustment to the number of shares or the number of companies outstanding to reflect the split. So there'll always be an adjusted number of companies. That will never be the 3. So in the Dow, I forget exactly what it is right now, but I think it's somewhere around 62 is the divisor. And that's because of all the various splits that have occurred over the years. So it's always an adjusted amount that will be created to calculate the adjusted number of shares outstanding and when there have been splits. But even so, regardless of splits, it's still the high dollar valued stocks that will drive the index one way or the other. So really what we're looking at in this type of index is the fact that you've bought one share of each one of the companies. You bought one share of stock A, one share of stock B, and one share of stock C, and you've held them. And that's really the theory behind the index. Now why is the Dow Jones using this price-weighted index? Because it doesn't really seem to make a lot of sense that one of the most highly tracked indices uses this price-weighted index, because it doesn't take into account it does the splits, but it doesn't really take into account the broader-based market, and it's so easy to create, and it seems to be manipulated based on the high-value stocks that are used. Well, the reason is it's very, very simple to create. Now, if you rewind the Dow, which is the first index ever to be placed on the open market and ever to be tracked, back in the good old days, we didn't have computers, and certainly no iPods, hard to believe, I know. No, there were no computers, so everything had to be calculated by hand, and this was a simple methodology that people could create, and it's actually one of the reasons why the Dow has survived as an index because of the longevity, and it's the only index that can go all the way back to the early 1900s so that we can utilize them to have a look at historical trends. So we stuck with the Dow Jones Industrial Index, we stuck with the price type index, but the modern era with computers and that, most of the new indices have moved over to the weighting within the market capitalization type index, and let's turn our attention to that. So the next example is an example of value creation of index. In this case, we need two inputs. We need the amount of shares outstanding, which we have here, and then we need the share price. And what we do to create this index is we basically just multiply the shares outstanding with the share price. So for example, here you've got, what's that, 500, 750 million, and etc. You can do the mathematics back home, but if you sum all of these together, then you get a value for the index of 5,075. Now we're going to move up here, and we're just going to change one input, which will be the value of this share. Share B, we've changed from $25 to $37.50, which is again a 50% increase. And we've multiplied them by the shares outstanding, the new values, which gives us a value of 6,638, which is an increase over the original index value of 5,075 of 30.8%. Once again, let's go back here, and we've increased the value this time just of the high dollar share. Remember, in the Dow Jones, moving the high dollar share price up by 50% really moved the index. So we've raised the high dollar share up by 50% to 60. And this creates an equity value or an index value of 5,675, which is really a 12% to 11.82% move in the underlying index. So what you can see here by this example is it's the high market capitalization stocks that are going to be driving this portfolio or this index higher, because the $25 into 125 million shares gives it a far larger market capitalization than the $1.2 billion or whatever we've got here in the market cap of the smaller stocks. So the key thing to know is that these value indices are driven by the higher market capitalization stocks in the portfolio. Another interesting development in the value creation of indices has been that they've moved it for an adjustment more to the outstanding shares rather than all of the shares outstanding. And the reason for that is because we as investors can't buy all of the shares outstanding. So what we need to do is limit it to the outstanding shares, or the free float as it's called. And so what they've done is they've reduced the actual market cap to reflect just this free float. This is a better reflection of what's available to the portfolio managers, because typically there's a premium associated with buying the whole company, and that won't be reflected on the stock market, in which there's just a minority interest trading. So the change to a free float has had a decent impact, and it makes it more closely related to the actual trading styles and the availability to the underlying portfolio managers. In addition to this, the value investors, because anytime there's a share split, it'll automatically be recalculated. You don't have to go and change the divisor to reflect the new shares outstanding or the split in the value of the stock, because it'll automatically be reflected in the market cap. You have, let's say, a 50% or 100% share split, 2 for 1, then the value of that stock's just going to be cut in half, and you're going to end up with the same market cap. So this index will automatically recalculate itself or adjust for any share dividends or share splits. And the third type of index creation is equally weighted, which, as I've mentioned, is just an equal dollar value invested in each one of the companies. Now, the only problem with that, A, it's not used very much. It's used by Value Line. But B, the main problem with that type of calculation is it constantly has to be rebalanced, because what you'll have is you'll have a movement up in the value of a stock, and that'll, of course, now it won't be equally weighted anymore. So you have to determine when and how often to revalue the underlying index to take it back to an equal weighting. But what it really works out is that's sort of the closest, in a way, to a portfolio. Most portfolios will allocate at least a certain percentage amount to each individual holding, rather than based on market cap, or a lot of times they'll do it that way. So a lot of times this is more closely related to the overall portfolio manager's investment philosophies. However, very few indexes actually do this because of the constant need to adjust the portfolio.